Is there going to be a mortgage rate crash?
The consensus out there is that we're going to get another 2 cuts at least. We're at 3.75% now, so taking us to around 3.25. If you ask some of the more bullish forecasters out there, and they'll say it could go even lower, 3%, or 1 or 2 out there saying 2.75%.
If we do really start seeing signals of significant upticks in unemployment, could that push that bullish case further, do you think?
The economy's not in a good place at the moment, and the Bank of England has one eye on that as well, financial stability as a whole. They've got to balance those risks. I think absolutely, yeah, they'll see the economic situation in the early part of 2026 and think we probably need to keep going with this in order to give the economy a boost.
I am one of those 1.8 million who will be remortgaging or refinancing my home in October, so I've got a very keen eye on this. I really want to kind of get a sense of where we're headed.
The problem is we have a neighbour down the road who was a forced seller of his property, sold it for something mad like 235. And that leaves me thinking, okay, well, if we're really this down on our buying price and we struggle to beat what the neighbour did for it.
They will make you do an affordability test to make sure you can afford the loan. You'll go through credit checks. And then what they'll want to do is sometimes either send someone physically out to your house to say, we think it's worth this.
Hello, everybody. Welcome to the Mouthy Money podcast. I am joined as ever by Chris Chute, who is head of consumer finance at PR and communications consultancy MRM. Chris, hello. How are you doing?
My head, I'm all right. Thanks. How are you?
Yes, very well. Thank you. Busy as we get back into the swing of things here in January. We're still looking ahead at what's going on this year and some important stuff to have in our minds. And to do that, we've got longtime friend of Mouthy Money and actual colleague, because he is a mortgage market expert on the Mouthy Money platform. We're joined by Paul Thomas. It's not his first time on the podcast. Hello, Paul. How are you doing?
Hello, gents. How are you doing? Thank you very much for having me and for having me back.
Lovely. Well, it's always a pleasure to have you on. The reason we have you on is because you know your mortgages, Paul Thomas. And we want to know from you today what is going to be happening this year in the mortgage market. Now, before we kind of dig into the weeds on this, I was going to throw some numbers around. The big one I think that we wanted to talk about was 1.8 million people remortgaging this year, or I should say homeowners, I guess is probably the right phrase in that.
Yeah.
So what are we going to be looking at, Chris? We're looking at a little bit of what's going to happen to the mortgage market. What does that mean for properties? What should people be doing? What else have we got on our minds?
Well, rates, right? Where are they going to be? I am one of those 1.8 million who will be remortgaging or refinancing my home in October. So I've got a very keen eye on this. I really want to kind of get a sense of where we're headed. We had a little bit of a rate cut just before Christmas, didn't we? So it's like, well, is there more to come? Can I get excited? Can I start to budget for other things in my monthly household budget? All those important things that I'm sure are important to our listeners as well.
Do you know what's weird, Chris? We've been doing this podcast long enough now that I think this might be the second time you've remortgaged on the podcast. Or
it could be, actually, yeah. I did a 2-year
mortgage. You keep plumping for these 2 years. I mean, come on, do a 5-year. That's what I did.
5-year it was a bit toppy, the last lot, so I thought I'd see if I could come down the other side of the mountain first, Ed, which it looks like we might, but Paul will know more than that.
Right, we're gonna have a little bit look about what difference with 2 years and 5 years, all that kind of good stuff. So let's not leave him waiting any longer. Paul, is there going to be a mortgage rate crash this year? That is what I want to know.
Your fingers crossed, Ed, underneath the table.
Well, gents, I've got some pretty good news for you. Yeah, I don't have a crystal ball, but the consensus out there is that we're going to get another 2 cuts at least. We're at 3.75% now, so taking us to around 3.25. If you ask some of the more bullish forecasters out there, and they'll say it could go even lower, 3%, or 1 or 2 out there saying 2.75%. But they're outliers, and you know what they say about forecasters? They make fortune tellers look good. So nobody knows. But unless the world radically changes, then we should have a couple more in 2026.
Okay, so what are obviously I know we've talked about this before on the podcast, but for people who haven't listened in, there is an interplay between the base rate and the mortgage rate, the rates in the mortgage market, I should say, and they're not necessarily immediately clear cut, are they? So what does that kind of base rate reduction do to what the mortgage market looks like more broadly?
Yeah, I mean, yeah, you're absolutely right. So just because base rate goes down doesn't necessarily mean that mortgage rates will come down as well. I mean, that's the theory. They tend to follow. So if the Bank of England cuts rates by 25 basis points, you should see mortgage rates come down. What the way mortgage lenders price their fixed rate mortgages is pretty much on the market consensus of where rates are going to be. So they don't price for today; they price for the future, where they think base rate's going to go. And at the moment, the market is saying the market consensus is we'll see another 2 cuts. So there is an argument to say that mortgage lenders have already priced in those cuts, so mortgage rates can't go much lower, even if base rate does go. So the Bank of England does cut base rate by 50 basis points or 0.5 percentage points. But there's so much competition in the market now. People are throwing words around, bonanza, rate war, those types of things. Lenders are climbing over each other to get new business, to get people to come to them to take up mortgages so they can, obviously boost their profits. So this is a really, really competitive time at the moment. So you would expect to see mortgage rates come down as well.
So I want to pick up on your point about there's some bullishness as well about interest rates. And I think I fall into that camp personally. My reasons for being, I should say, bullish on rate cuts rather than anything else. Because actually, I think when you look at some of the economic markers, putting aside all the geopolitical uncertainty and all this kind of stuff we've already talked about recently, I would err on the side of more rate cuts this year, mainly because I think inflation is going to be softer than we expect. And I think that's partly to do with things like oil price and that kind of thing is come down quite a lot, and that's still yet to feed through, which weirdly enough still has a big impact because energy prices feed into everything, right? But I think I'm bullish about it actually because of one specific reason, which I wrote about last week on Mouthy Money, actually, and that was employment. And unemployment specifically is starting to look a bit concerning. We've hit that 5 million figure now, I think, for unemployment. Just had the new Workers' Rights Act come into force. That's not going to encourage more employment. We've got more national minimum wage rises. That's not going to encourage employment. Anyway, where am I going with this? Unemployment, Bank of England doesn't like that, right? So it's going to do things to stimulate the economy. So do you think that if we do really start seeing signals of significant upticks in unemployment, could that push that bullish case further, do you think?
Yeah, definitely. So, for the last couple of years, the Bank of England, as you said, has been so focused on making sure that price rises don't get out of control. They took their eye off the ball a few years ago, got a load of criticism for that, and now they don't want that to happen again. Like you said, so wage growth, that's an important sort of indicator that they look at, and that's been coming down because, if wages are growing too much, then people have got a bit more cash in their pocket, or they feel like they have. They start spending, keeps prices higher, so inflation rises, in other words. That's definitely a factor. Those two coming down kind of changes the game a little bit. So, the Bank of England will say, and is still saying, that their key focus is inflation, and they won't want to do anything that makes prices increase even at a faster rate than what they are already, because they're still not back down to at the 2% target the Bank of England would like. But similarly, we're reading, I'm not going to mention the newspapers, but if you look, you know which ones I'm talking about. They're talking about a jobs apocalypse in 2026. And, the situation is a bit fraught. The economy's not in a good place at the moment. And the Bank of England has one eye on that as well, financial stability as a whole. So, they've got to balance those risks. And if they see that actually inflation is coming down, we've got a bit of maneuverability here, then I think absolutely, yeah, they'll see the economic situation in the early part of 2026 and think, we probably need to keep going with this in order to give the economy a boost.
I'm a little bit more bearish on that, Ed, I think. And the one thing that sticks in my mind is, and I don't want to get too technical here for our listeners, but there's a committee of people who set the base rate, right? So there's 9 people at the Bank of England, even though the Bank of England has a governor. And when they voted for the cut in December, it was still very, very tight. So I think only five people voted for a cut and 4 people voted against the cut. So that suggests to me that there's still a lot of nervousness. Now, listen, the situation might change around them. You make a good point around employment, and you make a good point around sort of the job apocalypse, I think you called it, Paul. That is a major concern because that has further reaching impacts and social impacts and all the rest of it. But I'm not sure inflation genie's right back in the bottle, and we've got so much geopolitical uncertainty out there. We're edging towards. Look, the war in Ukraine has created a sort of inflationary pressure as well as many other things, but which are far more important, I suppose. But looks like it's edging towards resolution, but we're not quite there yet. We've got other kind of geopolitical uncertainty unleashed everywhere, and I'm not so sure that based on my experience of 2025, that something might come out of the clouds and end up meaning that that doesn't quite go back in. We can't put the lid on it just yet. So I think there's a caution. That suggests to me there's a caution, and the two feels about right to me. But
so I'll counter that with a UK centric view here. So obviously we had tariff wars and this kind of thing last year, and there's quite an interesting effect for the UK economy that I read about, for particularly in relation to China. So obviously they imposed the tariffs on China to make it more expensive for Chinese imports, and that leads to a situation where the Chinese manufacturers suddenly have an oversupply of a lot of goods that they no longer have cheap access to the US market with. So what they have to do is they have to dump those goods elsewhere in order to clear their inventories. And that benefits countries like the UK that will get disinflation because cheap Chinese goods are coming on shore and they're having to cut the prices of those goods in order to, get them out the door, basically. And actually that could help this year. I mean, we're still waiting for a lot of these effects to flow through. Economic systems, it doesn't happen overnight. It takes time for this stuff to flow through. That could also benefit it and keep a sort of lid on inflation, so to speak. But again, I mean, this is all speculation, right? Let's bring it back to what this means for normal people. Paul, in terms of the actual mortgage market itself this year, what is your sense of how things are going to move? Do you have any kind of relative levels that you think we might be getting to in the next few months, particularly for, all those people who are looking at remortgaging now will have that in mind?
In terms of interest rates?
Yeah.
So I mean, I think we'll see another base rate cut probably by spring. And then if you look at the consensus numbers, then probably sometime in the second half of 2026. Obviously, if inflation comes down durably, the Bank of England again may think they have more wiggle room. But I think, to play it on the safe side, I'm probably looking at one in the first half of the year, one in the second half of the year, bringing us down to about 3.25%. So if that happens, and bear in mind, so if you're rolling off a 5-year fix from 5 years ago, it's going to be a shock for you because your mortgage rate is probably going to be sub 2%, even some of the lucky ones sub 1%, and you're going to be looking at a significant increase, 2-3 percentage points higher. So that is obviously going to be a major issue for them. But then you're also going to get people like Chris, people like myself, people like you, I think actually, Ed, maybe not you, Ed, I think you said you had a 5-year fix, but I'm on a 2-year fix rate. So I thought I was doing the smart thing. I had a 2 up, 2 down mid terrace. So I thought, we're not going to stay here very long. My wife's going to get itchy feet eventually and say we need a bigger place. So I got a 2-year fix. And then that suddenly didn't look like such a good move. So I've been rolling that over ever since. So hoping that one day it'll work out correct. Just goes to show that just because you work in the mortgage market or report on the mortgage market, actually, doesn't necessarily mean you know what you're doing. So, or I certainly can't tell the future. But yeah, no, I think the problem is, you're going to have some people who are going to feel better off, relatively speaking, compared to where they were 2 years ago, because they'd already gone through the pain of seeing their mortgage rate go up. But you are going to get, and there's a big number of these people, a couple of 100,000 people who are experiencing rising rates some of them for the first ever time, and that is obviously still going to be a shock. So that hasn't worked its way through the system yet.
So Chris, you remortgaged at probably quite a bad time when you were doing it.
All right,
18 months ago.
No, I did. Yeah.
Me too.
October 2024, gentlemen. Yeah, I did. Yeah.
Are you hopeful now? You're going to get something a bit better?
Yeah, without a doubt. Yeah, look, I've always counted myself as a little bit on the wrong side when it comes to timing of when I get my rate. So I remember for my first property, over 10 years ago, I ended up paying, when everything was on rock bottom, I was still, my rate was still in the 4s just to kind of get on the ladder. So, but it was still 300 quid cheaper than the rent my wife and I were paying at the time. So we decided to go ahead and do it, and it worked out well. Now, it was sort of complicated slightly by the fact that I had 2 aspects to my mortgage. So I ported one over from my original flat and then borrowed some more money, which was the right thing to do at the time in order to move into the place we're in now, but was trying to kind of get those 2 tram lines to come in together so that because one had sort of a 3-year horizon and one had a 2-year horizon. So I wanted them to come off at the same time so I'd have more of the market to explore rather than waiting for, half a loan to come off. That makes it more difficult. So we made the decision to try and do that. And then as Paul rightly mentions, the cost of living crisis spiraled and we found ourselves where we are. So in answer to your question, in the high 4s is where we are now. Based on that base rate, I'm hoping it will have a 3 in front of it. And that will have a very meaningful effect on our monthly budget. a huge effect. Yeah, that could be not transformative, but that would ease a lot of the pressure that we've been feeling in recent times. And I suppose that's kind of, to your point about the Bank of England and employment, and also about consumer demand. That's materially impacted our consumer demand, if you like. We've been forced to tighten our belts. We've been forced to make different decisions about where we go, what we do, how often we go out, all that kind of good stuff. So yeah, if things do start to ease up a little bit, then might have a bit more disposable income to spend.
Yeah, look, I mean, there's a bit of hopefulness in my personal outlook on what interest rates are going to do this year. Like you said, I mean, I've said this several times. Every time mortgages come up, I lord it over everybody who'll listen to me, because I booked
hate comments in the comments, please.
Because
listeners, I'll start.
I'm leaving one now.
Yeah, I booked a sub 3% interest rate as a first-time buyer for 5 years in 2022. I've effectively just missed the entire cost of living crisis with my mortgage.
Sailed through serenely, Ed. There we go.
And I'm going to be remortgaged. Oh no. And I'm effectively going to be remortgaging in about June 2027, when we've probably already had whatever economic correction is coming is probably going to have happened by that point. If and when, if it looks like a recession, the recession. If it just looks like a widening unemployment that sends interest rates lower, then fine. I mean, the kind of corollary to that is my house price has not done what I've hoped it would do, and it's complicated that. And we're going to come on to that shortly, I think, just to talk a bit around what that effect can have, because there is a lot more discussion of where the property market is, and actually I'm quite interested to understand what, and I'll illustrate in a second, what that means for my remortgage. But look, yeah, even if rates don't come back down to where they were when I first got the mortgage, if I'm getting a 3.25 or 3.5% mortgage when I come to remortgage now, it's probably going to be all right for me. It's not going to be the end of the world. It's certainly not what people went through in 23, 24 when they were remortgaging and facing £800, £900 extra a month or something crazy like that. Because that's a massive hit. But that's a function of interest rates, isn't it? It's designed to work like that. It's doing its job. If you're not feeling pain, it's not working. And that's what it's supposed to do, to get inflation down, right?
And you've hit the nail on the head there. So when the Bank of England were increasing rates and were indicating there were further rate increases on the horizon, the decision's kind of taken out of your hands, isn't it? If you're coming up to remortgage, chances are you're right. I'm going to go for a fixed rate. I don't want my mortgage repayments to go up every month. And if I'm not planning on moving anytime soon, I'm probably going to go for 5 years or even longer. As long as I don't think within that time window rates are going to come down. And at that time, we didn't know. We thought this was the 5% interest rates are going to be the new normal. And that's what people were talking about at the time. When rates come down, it's a slightly different prospect. And in some ways, it's a more difficult scenario to be in, because you're thinking, well, I could lock in now because I can afford this and it's less than what I was paying 2 years ago. In your situation, Chris, it's less than what I was paying 2 years ago. But if I say I went for a 5-year fix, am I then going to be overpaying for most of those 5 years? Do I go for a 2-year now and hope that in 2 years' time that interest rates will have come down even further and I'll be better off, and then I will lock in for a long time? So I mean, I can't. It's what you decide is ultimately dependent on your situation. If you move around a lot for work, then that's probably not a good idea to lock in for 10 years or 5 years even. If you're going to stay where you are, might be a sensible decision.
Well, that dilemma is exactly why Ed is dubbing me off air 2-year toot, because I'm probably going to, let's do 2 more years and see where we are, and before you know it, I'll be 70.
That's not the only thing he calls you, Chris.
Yeah, look, mate, if you just keep rolling that roulette wheel, you're just going to keep hitting the wrong numbers. It's just stick, don't twist.
We'll see what I'm offered in October. We might do a live show, listeners. Stick or twist, higher, lower.
Maybe we could do like a secret shopper, and you can put hidden cameras up and go and see a broker and see what they do. And
nice idea.
The look on your face when it glazes over, like, oh no.
No, here we go. Here we go.
This is also why we don't do the money Christmas party in a casino, by the way. Just don't worry about Chris following him around, making sure he's not doing anything daft every 2 minutes.
It's like that when people play 21 or blackjack, and it's like, you've got 2 kings here. You hit me,
twist.
Hit me.
Yeah, I feel lucky. Yeah.
No, so look, okay, I was before we go on to some of the kind of stuff around remortgaging practicalities and bits and pieces. Paul, I don't know, have you got any sort of longer term expectations for where things might settle in terms of interest rates? I know it's a bit of a mug's game forecasting, but the thing that kind of rings in my head is obviously we went through a period after the financial crisis where we had literally almost zero level rates. We're not going to go back to that, but there are still a lot of things in the world, particularly things like aging population, all that kind of stuff. You can argue that we live in a deflationary world that lends itself to lower rates. So how do you feel that sense of slightly looking forward, and what does the mortgage market say about that?
Yeah, I mean, yeah, you're right. I think if you're hoping for us to go back to 1%, sub 1% rates, you're going to be bitterly disappointed. That's not going to happen unless we see another financial crisis part 2. Then we can discount that almost immediately. I think what we're going to see is we're going to get down to about 3.5%, roughly speaking, and then we'll see a bit of a holding pattern for a little while, and then we'll probably have a range of 4.5% to 3.5%, and rates will move, as and when needed by the Bank of England to control inflation, to boost the economy. And I can't really see it moving outside of that range for the foreseeable future. So again, I could be completely wrong, and I probably will be. The people paid lots and lots of money to make predictions on this sort of stuff, and they get it wrong all the time. But that feels like a sensible forecast for me. I wouldn't expect it to go much lower than that. Wouldn't expect it to go much higher than that as well. So I think over the next 5 years, in 5 years' time, if I had to guess, I'd say around 3.5%, 4% maybe.
All right, I'll put a calendar invite for them, and we'll check back. No, look, okay, so the practical thing I wanted to talk about a bit with remortgaging, and we've talked about this on the podcast before. Obviously, I had that nice 5-year mortgage rate, but the problem that I've had in our house, my wife and I, is that actually our house price has looked a little bit not as nice as we might have liked it, shall we say. I'll explain the situation to you, Paul. We were thinking about moving at the sort of back end of last year. We paid 285 for the house. We've got about 240 odd left to pay on the mortgage, which is okay. If even if the house price doesn't grow, if it maintained the value we bought it for, then it's looking healthy in terms of equity. The problem is we have a neighbor down the road who was a forced seller of his property, sold it for something mad like 235. And that leaves me thinking, okay, well, if we're really this kind of down on our buying price, and we struggle to beat what the neighbor did for it. Now, there's a lot of circumstances that could lead into why they might have sold at such a low level. Does that have an impact on remortgaging? Do mortgage lenders look at what your house is currently worth? How does that work?
Well, yes and no. It kind of depends. And the reason I say that, there are 2 different types of remortgaging. So there is traditional remortgaging, which is move from lender A to lender B, mainly because they offer a better rate, but not always, could be other reasons. And then there's option B, which is strictly not remortgaging. The mortgage industry call it in industry jargon refinancing. So that is staying with your existing lender in what's called as a product transfer. Basically, you come to the end of your 2 or 5-year fix. They say, these are the rates we got on offer. Which one do you fancy? So if you were to, let's say you wanted to move to another lender because you see a really good rate, it's way better than what your existing lender's offering. You think, actually, this will leave us significantly better off. I think it's worth moving. What you'll have to do then, they'll treat this a new application. They don't know you from Adam. They will make you do an affordability test to make sure you can afford the loan. You'll go through credit checks. And then what they'll want to do is sometimes either send someone physically out to your house to say, we think it's worth this. And because when you put in your mortgage application, you'll give an indication how much you think it's worth. Or they'll use complicated computer algorithms to guess roughly what the price is. And then they'll come back and say, either agree, yes, no problem, Ed, or to the other borrower, yes, no problem. We agree it's worth 285, on you go. So that obviously, if your house price has fallen, that could be a little bit of an issue. But if you're just sticking with the same lender, then it's not so much of an issue. So most lenders then will say, look, we already know you. We already know that you've kept up with your repayments over the last 5 years. We like you. We want to keep you as a customer. Here are our rates. You won't have to do a credit check. They won't have to check if you can afford to pay the mortgage because they already had that for their 5 years worth of evidence. and they don't need to send anybody out to value your house because they already lent on it on the basis of it being worth 2,855 5 years ago. So essentially, yeah, you're not stuck. You're not going to be what the media like to call a mortgage prisoner. You'll be able to get a new rate. It just means that it may be better for you in that circumstance to stay with your existing lender. But what I would say on that point is, don't worry, don't be overly concerned that one property goes for way less than yours or way less than what you think your property's worth, because there could be very good reasons for that. They could really need to sell because they need to move away and they're willing to take a hit on it, when to lose money on the property. It could be that they've defaulted. It could be the bank, is trying to repossess the property. It could be plenty of reasons why that's gone for less than the market rate. So if you did move to another lender and they did send out a valuer, or they did even use their computers, what's called a desktop valuation, to value your property, they won't just look at that last one. They look at, what, I don't know how many bedrooms you've got, but say you've got 3 bedrooms, it's got a conservatory, X number of square meters, and they'll look at in the locality similar properties and what they've sold for over an extended period of time. So not say last week or in the last month, to build up a picture of what homes in that particular area are worth that look like yours. So it's not ideal, and it scares people because you think, oh my God, I thought it was worth this, but it should have been worth, but this one went down the road for less. And people get worried about it. What I will say, it is a bit of a difficult market still at the moment, but it's all of the experts that I read say that we're in for a better market this year. So slightly better housing market, considerably better mortgage market. So if that pans out, then that should be probably less of an issue.
There's going to be a sweet spot as well, right, in the market this year where we reach that kind of golden rate level where a lot more people are happy to be either buying, getting on the ladder. We've also had some easing of the rules in the past year, haven't we, in terms of lending, make it easier for people to get on the property ladder. That should help. And then there's also, and this goes underreported sometimes, is that although we have had a lot of inflation in the past few years, we've also had a lot of real terms wage growth. And actually, property market, broadly speaking, hasn't really gone up in real terms, has it, at all? So actually,
no.
With rates coming down, lending criteria getting better, and actually that affordability getting better because people are actually earning more money, there's going to be a sweet spot where suddenly all those things lock in and the housing market decides to kick off again in a way that kind of helps owners ultimately. But I think we might be nearing that kind of, I mean, for me anyway, it feels like it's kind of darkest before the dawn sort of thing, isn't it? March, April rolls round, people start getting a little bit better weather, putting their things on. I don't know, they're kind of trying to give people reasons to be optimistic here. There's so much that feeds into it, but I think there are reasons to be hopeful, possibly. And of course,
yeah, definitely, yeah, and you've seen that over the last couple of years. So if you look, 2022 was a really bad year for the property market and the mortgage market. A lot less lending, a lot fewer transactions. I think things are looking pretty bleak. And people will stay in put because of that, because, when you get a sense that the property market is starting to grind to a halt, then you're thinking, well, what's the point of me putting my house on the market now and I won't get as good a deal as I thought I might? It feels very different now. It's not back to where we were, say, before that. So immediately after the pandemic, where everyone was locked away for 6 months and thought, brilliant, I'm going to get out and sell my house, and the price of everything went through the roof. But it feels stronger, it feels better. Definitely lenders feel more willing to lend. So, and that is why we're seeing a lot of competition in the market, which are keeping rates possibly lower than where they should be for considering where base rate is. So I think, yeah, definitely there's an appetite from banks and building societies to lend to you, and it feels like everything's picking up a little bit. It's a lot better than it was, say, 12 months ago.
All right. Reasons to yeah, go on.
Sorry, so if you're one of those 1.8 million, of which I am, this year, what are the practicalities of, looking at your mortgage deal? Because you can lock something in 6 months before, right, Paul? What kind of things can we do to try and make sure that we're getting the best rate?
Yeah, for the first things first, yeah, absolutely. Look at your mortgage docs. When is your mortgage up? Say it's in August, then from February, with most lenders, not all of them, some of them got different criteria, which means that, it's 4 months before, 3 months before. But I think most now will be 6 months. And I think that is your first port of call. So if you have a mortgage broker, get in touch with them if they haven't been in touch with you already. Explore your options. don't just take the first rate that your lender is offering you, your existing lender's offering you. You may think it's a really good deal, but it's worth having a look around to see whether or not you can get something better on the open market. And it may be that you can't, by the time you factor in fees, because when you move to a new lender, normally the fees are higher than if you stay with your existing provider, your existing bank. So you've got to factor all that stuff in, the total cost of the loan, and whether or not you think it's worth shifting the money somewhere else. But I'd say, go. If you don't use a broker, then see what's on the market. Have a look at comparison sites. But I would recommend going to a broker, because this is complicated stuff and it's a big transaction, so you want to get it right. So assuming you do go to a broker, then ask them to look, see what else is on the market, and then make a decision from there. And it may be the case that you think, actually, by the time I factor in the fees of moving elsewhere, and I don't, it's probably not going to be worth it. Or if you've got to go through the credit check process again, you think, really, am I going to go through all of that just to save, £10 a month? Is it worth doing that? And you're happy with the existing rate, then you can always take the existing rate from your existing lender. Where, but I think the important thing is, don't leave it to last minute. You've got a 6-month window. So if your mortgage is up in August, don't leave it till July. So while if you're sticking with your existing lender, while it doesn't take that long, you'll want to give yourself a bit of a run up and to keep your eyes open and see what's on offer in the market, and if you can get a better deal elsewhere. So I think just don't leave it to last minute. It'd probably be my advice.
Mm-hmm.
Brilliant. Well, I think we've got reasons to be hopeful in 2026 then with the mortgage market, would be my summary. I think this is nice. I feel like a lot of the time we pick out the things to worry about in the world, but maybe that might not be the mortgage rate that you have to get in the year ahead. Chris, are you feeling hopeful?
I am, because almost certainly, touch wood, based on everything we've discussed today, I'll be getting a cheaper rate towards the end of this year, barring any other catastrophes. So let's not rule those out. Yeah, that will be a big help. That will be a big help.
Well, I think that about wraps up. Do give us your thoughts in the comments. Let us know, as ever, what your remortgage issues have been, what kind of rates you're getting, your general experiences, whether you're unhappy, happy, that sort of thing. Do let us know. So with that, Paul, thank you so much for joining us to talk through the mortgage market.
Thank you very much, Jens, for having me. And maybe next time I come on, Chris, you'd have got a better mortgage rate and you'd be very happy with everything. And if not, don't blame me.
Brilliant. Thank you, Chris, as well.
My pleasure, Ed.
And thank you, everybody, for tuning in. We'll speak to you all again, hopefully very soon. With that, thank you and goodbye. Don't forget to subscribe to the show on Spotify, Apple Podcast, or YouTube. You can also follow all our latest updates on TikTok, Instagram, or X. Finally, check out all our money stories on the Mouthy Money website and subscribe to our weekly newsletter for all the latest straight to your inbox. Thank you and goodbye.